In the last few weeks, we've seen a crash in cryptocurrencies, volatile commodity prices, and market slowdown amid fears of recession and soaring inflation. Rising inflation often means an increase in cost of borrowing, which leads to banks upping their interest rates on deposits. And that is exactly what central banks across the globe are doing as we speak. After dealing with low interest rate environment, one may see a glimmer of hope for fixed deposit buyers. With the RBI upping interest rates and the likelihood of more hikes in the coming months, banks have started raising interest rates payable on FDs. But is switching to bank FDs a good option? Not yet. Here's why. So far, interest rate hikes announced by banks are nominal in nature. Though lenders have been raising interest rates and you may see signs such as up to 50 basis point increase in interest rates, it is being offered only on long-term fixed deposits, which are typically of more than 3 years tenure. The interest rates on FDs of 1 or 2 years, which is the most used option, has gone up by merely 10 to 30 basis points in most cases. And this is nowhere near the 90 basis points hike in repo rate affected by the RBI, and it doesn't come close to beating the rate of inflation. SBI, for example, pays 5.3% rate of interest for 1 year fixed deposits. A senior citizen gets 5.8% for the same. However, a treasury bill issued by the RBI and maturing in June 2023 offers a yield of 6.25%. Now, simply put, bank FD rates have not yet meaningfully gone up, especially if we see the inflation of 7.04%. Since we're in the initial phase of a raising rate cycle for bank fixed deposits, avoid getting into long-term FDs just because they offer a bit more than short-term rates. For instance, SBI offers a 5.5% interest on a 5-year period. Given the high rate of inflation, most bank FDs offer negative real yield. Post-tax returns further go down as interest received on bank FDs is taxable in the hands of the investor. Experts advise either laddering or staying in short-term fixed deposits. They, however, recommend avoiding FDs of 5 years or more. So what else can work for investors at this juncture? Well, for fixed income investors open to other options, there are options like corporate fixed deposits, tax-free bonds, government securities and debt mutual funds which can be looked at. Now, experts say corporate fixed deposits with similar risk profile offer better returns. For example, HDFC offers 6.05% rate of interest for a 15-month fixed deposit and HDFC Bank offers 5.35% for a similar tenure. However, just like in the case of bank fixed deposits, experts advise sticking to short-term company deposits over the long-term ones. In a rising interest rate scenario, it's also better to avoid companies with stretched balance sheets or poor fundamentals, as they may find it difficult to roll over their existing debt, even if they're willing to offer a higher rate of interest. Savvy investors can look at investing in short-term government securities or tax-free bonds, depending on their tax slabs, as these instruments offer attractive yields and there is very little credit risk. As the interest income gets taxed in the hands of the investor, the individuals in high income tax brackets may find it attractive to invest in tax-free bonds. Mutual fund schemes investing in short duration papers, be it target maturity funds or open-ended short duration funds, are also attractive for investors in high income tax brackets. But you need to match your investment time frame with the duration of the fund. If interest rates rise further, there could be mark-to-market losses as well. Hope this video was helpful. For more information on personal finance and market updates, log on to moneycontrol.com. And if you like the video, don't forget to like, share and subscribe.